If you had handed Warren Buffett $1,000 back when he took over Berkshire Hathaway and just left it alone, never touched it, never panicked, never sold during a single crash, that $1,000 would be worth more than $21 million today. $21 million from 1,000. That works out to an average return of roughly 20% a year, nearly double what the S&P 500 itself has returned over that same stretch. Now, here's what I find interesting. Buffett isn't a trader. He's not glued to 6 monitors watching candlestick charts. He's not chasing the next hot stock tip from a forum. He has spent over 6 decades doing the same handful of things over and over with extraordinary discipline. And he's talked about exactly what those things are in interviews, in shareholder letters, in conversations with students for years. It's not a secret. It's just rarely explained in language that actually applies to someone earning a regular paycheck, paying regular bills, trying to build a regular retirement. That's what I want to do in this video. I went through years of Buffett's public interviews and shareholder commentary and pulled out 6 principles that show up again and again, the actual operating system behind the $21 million. And for each one, I'm going to translate it into something a working American with a 401k, a Roth IRA, and a regular brokerage account can actually use this week. Not become a billionaire advice. Real, applicable, working person advice from the framework of the guy who's arguably done this better than anyone alive. 6 principles. Let's go through every one. Principle number 1. Cash is not an investment. Buffett has been blunt about this idea for decades. Holding large piles of cash long-term isn't safety. It's slow, quiet loss. Here's the logic. Cash doesn't produce anything. It doesn't grow, it doesn't pay you a dividend, it doesn't compound. And every single year, inflation quietly erodes what that cash can actually buy. $1 sitting in a non-interest checking account in 2026 buys meaningfully less than it did in 2016, and it will buy less again in 2036. Buffett has said he keeps enough cash around the way you'd think about oxygen. You need some, you always want it available, but holding excess of it sitting idle bothers him. He'd rather own productive businesses than sit on a mountain of dollars waiting for something to happen. What this actually means for you. This is not permission to skip your emergency fund. I made an entire video about why every working American needs one, and that principle doesn't change. Cash has a specific job, covering near-term needs and protecting you from forced selling during emergencies. But beyond that emergency cushion, money sitting in a regular checking account earning 0.01% interest year after year is losing purchasing power every single day it sits there. If you've got money beyond your emergency fund just parked in checking to be safe, it's not actually safe. It's quietly shrinking. Move it into something that grows. A high-yield savings account at minimum for near-term goals. An index fund for anything with a longer time horizon. Money should always have a job. Principle number 2. Invest in productive assets. This is, in my opinion, the single most important idea in Buffett's entire philosophy, and it's the one I wish someone had explained to me before I wasted 6 months trying to pick individual stocks. Buffett draws the distinction between 2 completely different categories of investment. The first category is something he describes using gold as the example. Imagine you owned every ounce of gold in the world, melted into a giant cube. You could sit on top of it, you could polish it, you could stare at it, but it doesn't produce anything. It doesn't generate income. The only way you make money from it is if someone else, later, is willing to pay you more for it than you paid, purely because they believe someone after them will pay even more. It's a bet on collective belief, not on output. The second category is what he calls productive assets, things that actually generate something on their own. He uses a farm as the example. You buy a farm because you expect it to produce corn, soybeans, or cotton every single year. You can calculate with real numbers what that farm should be worth based on what it actually delivers, the harvest minus the costs of working it. And because of that, you don't need to obsessively check the farm's price every single day. You know what it's worth because you know what it produces. Businesses work the same way. A share of a great company isn't just a number that bounces around on a screen. It represents a real business generating real profit year after year. Buffett has said that when Berkshire owns a business, he doesn't get a price quote on it every week and panic about the fluctuation. He looks at what the business actually delivers. what this actually means for you. This is exactly why I'm such a strong advocate on this channel for index funds over speculative assets like most crypto or collectibles or anything you're buying purely because you expect someone else to pay you more later with no underlying production behind it. When you own an S&P 500 index fund, you own a tiny slice of 500 actual productive American businesses, companies selling real products, generating real profits, employing real people year after year. That's why the price recovers after every crash in American history. The businesses underneath keep producing even when the stock price gets scared and dips temporarily. This is the difference between investing and speculating. Investing is buying something for what it produces. Speculating is buying something hoping someone else pays you more later with no underlying production. Know which one you're doing with every dollar. Principle number 3. Stay in your circle of competence. Buffett often references something IBM's founder Tom Watson Sr. once said about himself, that he wasn't a genius, but he was sharp in a few specific areas and he stayed focused there. Buffett has built his entire investing career around that same idea, which he calls your circle of competence. The principle is this: you don't need to understand everything about the market. You don't need to be an expert on every industry, every sector, every trend. What you need is brutal honesty about where the edge of your actual knowledge sits and the discipline to stay inside that edge. The danger isn't admitting what you don't know. The danger is getting excited about something outside your circle of competence because everyone around you is talking about it and jumping in anyway. What this actually means for you. I lived this lesson the expensive way. I told this story in my S&P 500 video. I spent 6 months trying to pick individual tech and pharmaceutical stocks based on forum chatter and social media tips. None of that was inside my circle of competence. I didn't actually understand drug approval pipelines or semiconductor supply chains. I was betting on excitement, not knowledge. Negative 11% later, I learned the lesson Buffett had been saying for 50 years. Here's the practical version of this principle for a working American. If you don't have deep, genuine knowledge of a specific company or industry, and most of us don't because we have full-time jobs that aren't researching individual companies, your circle of competence for picking individual stocks is probably smaller than you think. That's not a weakness, that's honesty, and it's exactly why a broad index fund makes sense for most people, because it doesn't require you to have a circle of competence in any single company, because you own all 500 of them. You're betting on the productive capacity of the American economy as a whole, which is a much easier thing to have genuine confidence in than predicting which single company wins next quarter. If you do want to own individual stocks, keep it to industries and companies you genuinely understand from your actual life and work, and keep it a small slice of your overall portfolio, not the foundation. Principle number 4. Evaluate the business before the price. Buffett has described his process for finding investments in a way that surprises a lot of people because it sounds almost old-fashioned. He reads annual reports. He's told the story of how he came across a major Chinese oil company years ago. He sat down, read through their annual report describing their oil reserves, their refining operations, their chemical business, and everything else, and concluded, based purely on the actual underlying business, that it was worth roughly $100 billion. Only after forming that opinion did he look at what the market was actually charging for it, and the stock was priced at a fraction of what he'd calculated it was worth. That gap is what made it a buy. The key sequence matters enormously. Value first, then price. He's explicit that if you look at the price first, it influences your judgment of the value. You start reasoning backward to justify a number you've already seen instead of forming an independent opinion. What this actually means for you, most regular investors do this completely backward. We see a stock price has gone up 40% this month, and we get excited and buy, without any independent sense of what the company is actually worth. We're reacting to the price, not evaluating the business. For 95% of working Americans, the practical solution isn't to start reading annual reports, though if that genuinely interests you, it's a real skill worth building over time. The practical solution is recognizing that most of us don't have the time or specialized training to do company-by-company valuation the way Buffett does professionally. And that's exactly why low-cost index funds remove this entire problem. You're not trying to determine if Apple is overpriced relative to Microsoft this month. You own all of them, and your job becomes simply continuing to buy consistently over time, regardless of what any individual price is doing this week. If you do want to evaluate an individual company yourself before buying, at minimum, look at their actual revenue trends, their profit margins, and their debt levels before you look at how exciting the stock chart looks. Substance before sentiment. Principle number 5. Don't waste your big opportunities. This might be my favorite Buffett idea of all 6 because it's the most counterintuitive and the most useful for regular people. Buffett has described an exercise he wishes every young person could go through. Imagine you're handed a punch card with only 20 punches on it for your entire investing lifetime. Every major financial decision you ever make uses up one punch. Once you're out of punches, that's it. No more decisions, ever. His point is that if that were actually true, people would think incredibly hard before every single financial decision. They wouldn't buy into some company a coworker mentioned at a party that they don't even understand just because it went up last week. They'd save their punches for the genuinely big, well-understood opportunities, and when one came along, they'd act on it decisively instead of dabbling in it timidly. The mistake, he's pointed out, isn't just inaction, it's also half-action. Recognizing a real opportunity and then only committing a token, insignificant amount out of fear, which he considers almost as costly as missing it entirely. What this actually means for you, I think about this constantly now when it comes to 2 different things in a working American's financial life. First, the temptation to constantly dabble. Every time you see a stock mentioned or a crypto coin popping off, that's the antithesis of the punch card mindset. Most of those moves don't deserve a punch, they're noise. And second, and this is the part I really want you to hear, your real punches as a working American are things like capturing your full employer 401k match starting on day 1 of a new job, instead of waiting 2 years like I did. Opening your Roth IRA at 22 instead of 27 like I eventually did. Choosing to automate consistent investing instead of waiting for the right moment. These aren't flashy moves, they don't feel like punch card-worthy decisions in the moment, but they are exactly the kind of high-conviction, well-understood, decisive moves Buffett is describing. They're just boring, which is precisely why most people don't treat them with the seriousness they deserve. You don't need 500 financial decisions in your life. You need a handful of really good, well-understood ones, made early, made decisively, and then left alone to compound for decades. Principle number 6. Invest in yourself first. The final principle is the one Buffett returns to most often when he's talking to students rather than investors, and I think it's the most important one for anyone watching this channel who's earlier in their financial journey. He's described your own skills and talents as the one asset that genuinely cannot be taken from you. Inflation can erode your cash. Taxes can take a share of your investment gains. But the ability to think clearly, communicate well, and do valuable work, once you've built it, nobody can repossess it. He's used a simple thought experiment with students. Imagine you're worth what you could earn over your entire working lifetime, and someone could buy a percentage of all your future earnings today. That number is often well over $1 million for an average career, meaning you are, in a very real sense, $1 million asset already. And specific learnable improvements, getting meaningfully better at communicating, written or verbal for instance, can increase that lifetime value substantially, just from one developed skill. He's also talked about something he calls building a moat around yourself, the personal qualities that make people want to work with you, trust you, and give you opportunities. Things like genuinely giving credit to others, being someone people enjoy being around, following through on what you say you'll do. These aren't soft, unimportant traits. He considers them direct contributors to your earning power over a lifetime. What this actually means for you. This connects directly to something I covered in my side hustles video. The freelance writing side hustle that changed my financial direction wasn't really about freelancing. It was about a skill I already had, clear communication, that I'd simply never thought to price and sell on its own. That skill had been sitting there, undervalued the whole time. Every dollar you spend developing a real skill, a certification, a course, deliberate practice at something valuable in your field has a return on investment that can rival or exceed anything in the stock market. Because, unlike a stock, that skill compounds inside you for the rest of your working life, and nobody can ever take it away. Before you ask, where should I invest $500? Sometimes ask, should $500 go into a course or certification that raises your earning power instead? Often, especially earlier in your career, that's the better trade. Let me show you how these 6 actually stack on top of each other for a working American building real wealth. Principle 1 tells you to stop letting money sit idle beyond what you genuinely need for safety. Principle 2 tells you where to put it. Productive assets that generate real output, like the businesses inside an S&P 500 index fund, not speculative bets on collective belief. Principle 3 tells you to be honest about what you actually understand, which is exactly why a broad index fund requiring no single company expertise fits most working Americans better than individual stock picking. Principle 4 tells you not to chase price movement. Automate your investing instead of reacting to headlines. Principle 5 tells you to make your big decisions decisively, capturing your match, opening your Roth IRA, automating your contributions decisively and early rather than dabbling at the edges with noise. Principle 6 tells you that before any of this, your own skills are the asset working hardest for you, so develop them deliberately. Run all 6 together and you get something close to the actual foundation of this entire channel. Automate consistent contributions into productive, broadly diversified assets, stay inside what you genuinely understand, make your big decisions early and decisively, and keep building your own earning power the whole time. That's not a billionaire's secret. That's a system a working American can run starting this week. $1,000 into $21 million isn't really the lesson of this video. Almost nobody is going to replicate Warren Buffett's specific track record. He's a singular figure in financial history, and I want to be honest about that rather than oversell it. The actual lesson is that the behavior underneath that number is shockingly ordinary and shockingly repeatable. Don't let money sit idle. Own things that actually produce something. Know what you understand and what you don't. Value things before you chase their price. Make your big decisions decisively instead of dabbling. Build your own skills like they're the asset they actually are. None of that requires being a genius. Buffett himself has said as much about himself. It requires discipline repeated patiently for a long time, which is the exact same message I've been making videos about since the $100 a month video. The principles were always available. Somebody just needed to translate them into a language that fits a regular paycheck. Now you have that translation. Drop a comment and tell me, which of these 6 principles do you think you're weakest on right now? And tell me who you want me to cover next in this series. I'm thinking about doing Charlie Munger, Jack Bogle, or Peter Lynch next, but I want to hear from you. Like this video if it gave you something real. Subscribe for more every single week. And if you haven't already, go check out my videos on the S&P 500, the Roth IRA, the 401k, and every type of investment explained. Together, this whole series is the financial education most of us never got.